Our first speaker is Rogan from ProFounders, and before we fire questions at him, I think we'd like to let him say a few words to introduce himself and the fund and various other bits and pieces. The floor is yours, sir.
Thank you, Mike. And with the graveyard slot, which is traditional after a very good meal, I will be relatively brief on who I am, because I'm the least important person here. A little bit more on the fund, because that's a bit more important, and then your questions, which are the most important things. As Mike said, my name's Rogan. I'm one of the founding general partners of ProFounders Capital. We are an early stage venture capital firm set up about 18 months ago with two tenets behind it. One was that we viewed a very good angel community, a large and very good VC community, but nothing in the middle. And so we wanted to fill that gap. I think since we've established the fund, others have also come into that space, and probably we should be calling ourselves either a micro VC or a super angel, your choice which it is. The second tenet is probably more important and got us some decent publicity, which was that we saw a number now of very successful entrepreneurs in Europe in the digital media and tech space, and we felt that there was sufficient volume there and sufficient interest from them to keep being involved in the early stage industry, to have more of a Silicon Valley approach whereby one generation of successful entrepreneurs will help the second generation. So the aspiration of the fund is that as well as capital, we will provide access to the experience, expertise, network and everything that goes with our investors, that include people like Brent Hoagman, who did lastminute.com, Michael Birch, who did Bebo, Mike Danson, who did Data Monitor, Andy Phillips, who did Active Hotels. What we look to invest in is between £500,000 and £1.5 million sterling. We're agnostic about whether we co-invest or do it on our own. We think the decision in that should lie with the company, not us. We look to invest in the broad digital media and technology space. For us, capital efficiency is a key criteria, both because we think that you can build a lot more than you could in the late 90s on a lower capital base thanks to open source software, viral marketing, etc. And also because of the interests of the investors that we have involved. But within those criteria, we can invest anywhere from a pure tech company to a consumer B2B, consumer internet site. To date, we've made 7 investments. They're all on our website, so I won't bore through them. And we are always happy to see more plans. Our other aspiration is to try to be clear, quick, and not waste any of your time. Questions?
Right. Question for Rogan? Yes.
Much better to have questions there, because otherwise you see Mike and Rose have prepared some, which I've already seen, so that's kind of pointless.
They've given our secrets away now.
Well, it's like the Oscars. Do you think they know or they don't know before they go out with their prepared cry?
What kind of projects have you invested in the past?
As in not in this fund?
Well, as in this fund.
So our 7 investments, and we have, our first investment was TweetDeck, which is, many of you will know, started life as a Twitter client. It's more of a management tool for all real time now. We have 2 next generation e-commerce sites, so that's made.com and Quinoa. We have an education site called Manga High. We've got I suppose you call it a game advertiser network called Amplifier. We have I'm going to do them a disservice, slightly social dating, social getting to know people site called City Socializing. And our most recent investment is a company called One Fine Stay, which is kind of unhotels, allowing you to rent out your house whilst you're on holiday, or indeed if it's a second house. I suppose the interesting thing about that last one is it's the first travel business we've done, despite Brent's involvement. But the reality is that the network we have all bring different expertise and different advice, and so that's not a bad thing. We don't want to be a kind of travel, we see a lot of travel plans because most of them come to Brent and then come to us, but we don't want to just be a travel fund.
You might want to ask your question that you asked earlier to Brent, to Rogan, in terms of the clarity of business model.
Was Brent here before? I just don't want to give a contrasting answer.
Earlier I asked, when products are being developed, so you have a 5-year business plan, 5-year business plan, how do you value a company, a web company, which evolves every iteration, and effectively its business model consistently changes, or in many cases consistently changes? How can you actually put together a real financial model for these investors, or for a realistic
Okay, so there are multiple points there, and you've hit on one of my bugbears. I should explain that literally ProFounders is my VC experience, so I'm more on the other side, either entrepreneurial or working in bigger media, and that has obviously advantages and disadvantages. One advantage is, as with any industry, they become accepted norms, and if you start from school and you go into VC, then you learn from the people above you and you replicate what they've done. And so I come in and not just to be contrarian, although there's an element of that, I say, right, these things look ridiculous. So let me tell you what I think. I love models, financial models, but I know that they're wrong. Inevitably they will be wrong. So I did the original model for lastminute.com with Brent, and actually found it the other day, and it is weepingly inaccurate as to what actually happened. So you're totally right. It doesn't really tell you that much if you're valuing a company. I think the reason I look at financial models is just to see the logic that an entrepreneur has applied to their business. And also, there's a kind of sanity check to make sure they're not just going, there are 6 billion people in the world, and if I sold one thing to each person, it would make 6 billion items, which is ridiculous. And I'm definitely going to answer your question, but maybe to give context, when I look at a company, and I'm very, very basic, not very intelligent, so I do 2 things. First thing is to say, is there, post 5 years, a dream? And I'm not going to try to quantify it to an exact number, but I need to know that there is the scale out there. And we can all talk about that, it's a relatively fluffy conversation. More importantly, I then look at the next 12 months. And what I try to work out is, what actually are the capital requirements, if I'm feeling radical, without any revenues? I know no business would work without any revenues, but just the costs are easier to forecast. And what might be achieved in terms of milestones? Because I'm very, very conscious that there will be another capital raise. And I'm a big believer that actually at the stage we're investing, which is often the first institutional capital, it's the time when you have most flexibility as an entrepreneur as to whether you take the money or you don't. As soon as you get onto that bandwagon, you've built up a cost base, which means that there is a time when you have to raise more money, either from us or from other people. And that's almost the most difficult time. And the way to alleviate that difficulty is to make sure that you've kind of ticked a few boxes. I've grown X number of subscribers, and whether that's realistic. In terms of valuation, as far as I can see, and there's no logic to this, every deal at every stage will get done for 25 to 40% of the equity. So the question actually isn't what is the value of my company, it's how much should I be raising? Because you flip that the other way around and you work out what the value of your company is. So, I mean, the argument goes, therefore you should ask for as much money as possible because you'll get the highest valuation. But of course there is a touchy-feely bit where people go, there's no way this company needs $50 million today. So really, I think the key number to look at and to prepare properly is how much you're raising. And if you prepare that number properly, from my point of view, I can look at it and go, with that much money, I can see that, with a bit of a good wind, the following milestones should have been hit, which will allow us to do the next round. And if they don't, because it doesn't always happen like that. Too little money is terrifying, because you and we will get screwed at the next round, or we will do the screwing if we follow, we won't, but if we follow on. Too much money and the valuation just gets totally out of whack. There's a long and rambling answer. I'm agnostic. You put up your hand first.
Do you do bimbos at all?
Sorry?
Do you do bimbos buying
we haven't. I think from my background, yes, because I'm much more on the financial side and I like those. Often, if I look at the investment committee, some of the members don't find them as sexy because they're not kind of new ideas often and stuff. But definitely it's worth a pitch. We don't have a rule saying we can't, but similarly we haven't done any yet. The one thing to tell you, just if you're interested, but where we're located and one of our investors is a guy called Peter Dubins who runs Oakley Capital as well. So we're under their FSA umbrella and we sit in their offices. Oakley Capital is a kind of mid-market PE, so I don't know how big yours is, but mid-market PE firm, which, well, I mean, it goes quite small, not as small as we do, but quite small, and they're more used to doing that, and they leverage it up and do it.